Here's the burning question on a lot of people's minds right now. For one, who is the Fed? Why is everyone mad at them? And what exactly are they doing to help our economy? The interesting fact is that the Fed has 400 PhDs and 18,000 employees. Yes, they have over 400 PhDs on staff and 18,000 employees. What exactly are they doing? And with that much brain power, how come everyone is so mad at them? First of all, the bottom line goal for the Fed is to manage consumer expectations. Ultimately, they want to create a calm environment in the country, avoiding mass pandemonium and runs on the bank. If you remember, It's a Wonderful Life, that was a theatrical representation of what a run on the bank looks like. So if you remember, a bunch of people flooded into the bank and they wanted their money now. It had to be explained to them that their money wasn't there. It was being lent out to others for other people's mortgages, for other people's loans. And that's the same type of practice that we have right now. Banks need liquidity. If they receive a greater than normal amount of withdrawals in a day, they can hardly tell people that they don't have enough money available. And so they need liquidity. Banks borrow from other banks. So let's say a bank received a greater than normal amount of deposits in a day, then they'll lend that money out to other banks who are in the red. The banks can also borrow from the Fed directly from the discount window. So there's two different places they can borrow money from. We'll get into this more in a little bit, but the Fed can set the rate or the target rate at which banks can borrow money from the Fed. It's called the discount window. Banks borrow money from each other, typically at rates lower than the discount window. If banks were to charge more than the discount window, then they would just go straight to the Fed directly. Many people think that the Fed was trying to help boost the economy for too long. So this is the predominant reason why people are, broadly speaking, upset with them. And what does this look like in practice? Well, if you look at inflation data since 2018, what you can see is as soon as COVID hit, the Fed dropped the Fed funds rate down to zero. The goal was to encourage economic activity by making the cost of money really cheap. People were able to take out car loans, myself included, credit cards, home equity lines of credit, adjustable rate mortgages. All of these things dipped pretty significantly because the cost of money was so cheap. Banks were able to borrow money at a very low rate and then lend it out at a much lower rate. This created a boom in activity at a time in our country where we weren't really expecting a whole lot of activity due to lockdown protocols. So what we saw is the Fed funds rate stayed low up until, really towards the middle of 2022. During that time, inflation started to pick up again. This is due to a multitude of reasons, of course, but a big one is the Fed's policy on keeping the Fed funds rate low, as well as buying mortgage bonds and treasury bills. So the Fed themselves were buying billions of dollars per month of mortgage bonds and treasury bills. Throughout the extent of COVID, the Fed ended up acquiring more than $2 trillion of mortgage bonds. The impact this had on the economy was that as there was greater demand for mortgages, the value of the mortgage bond increased and then mortgage rates went down. So the way a bond works is if the bond itself is in demand, the value increases, and then the dividend goes lower because the bond itself is worth more. They don't need to offer as high of a dividend or yield to investors in order to attract further investment. The Fed is said to have a dual mandate. In other words, they are expected to keep our economy running in such a way that we have maximum employment, which is a technical term, and stable prices, meaning the Fed wants to keep long-term interest rates moderate. This is what they are commissioned to do by the Congress. So how exactly does the Fed raise the Fed funds rate? The Fed has a target rate, as I mentioned earlier. When banks borrow money from the Federal Reserve, this is the rate that they are assessed at that they pay in interest to borrow money. Ultimately, banks are required to have a certain number of reserves, and so their reserve requirement is being charged interest at the rate set by the Federal Reserve. When banks borrow money from the Fed and from each other, As that rate starts to climb, then they just go ahead and pass that cost on through to consumers. What impact does this have on the economy? As the Fed raises the Fed funds rate and the cost of money increases, people might reconsider buying that new car if financing is twice as expensive as it was 6 months ago. Same thing with credit card debt. As credit card debt increases nationwide, as the interest rate that we're being charged, the APR on credit cards is increasing, then people might be less interested in going on vacations or doing other discretionary spending if their minimum monthly payment has doubled. That's applicable for those who carry credit card debt. So this has a cascading effect on the economy where it starts to put a wet blanket on this raging, roaring fire that the Fed is trying to calm down. Here's the next question that I get asked often. Can the Fed actually raise 30-year fixed mortgage rates? The answer is no. Mortgage rates are determined by how much are investors willing to pay for mortgage bonds. The value of mortgage bonds goes up and down relative to investor demand. Typically speaking, in a normal economy, as the stock market declines, as there's a sell-off, it's described, people are less interested in holding on to stocks as the value is plummeting. And so more and more investors are attracted to a safer investment, which is mortgage bonds. Mortgage bonds are safe because they're built on the back of homeowners who will make sure to make their monthly mortgage payment because they don't want to get kicked out of their house. So mortgage bonds are a very safe investment for investors on Wall Street. Your mortgage and mine are lumped together into larger investment vehicles that Wall Street can invest in. So here's a quick snapshot of today's mortgage market. We're up 25 basis points. That means the demand for mortgage bonds has increased. This is in reaction to comments that the Fed made today. It was that the Fed meeting minutes were released from earlier. What you can see is that we broke over a major level of resistance. Namely, traders on Wall Street watch a chart similar to this as they're paying attention to where the value of mortgage-backed securities are going. As the value of mortgage bonds goes up, rates go down. So with all this green that you can see, this is how we've seen over 0.5% of decline in mortgage rates. Rates went down over 0.5% over the last 2 weeks. This day was when the CPI report came out. We saw for the first time in over 12 months a break in the rapid increase in inflation. So the market reacted positively to that news. And so mortgage-backed securities gained value. Investors were interested in purchasing them because inflation is starting to go away, or at least that's how it appears. So the Fed raising the Fed funds rate does not immediately impact mortgage-backed securities because the value of mortgage rates, the going mortgage rate offered to clients, is not directly tied to the Fed funds rate. Banks are not borrowing the same type of money for mortgages as they are, other shorter-term debt. However, when voting members of the Fed speak, at least especially recently, that's when we have seen the Fed impact mortgage rates. So if the Fed makes an announcement that they're concerned that we have not seen the end of inflation, or otherwise implying that inflation is a runaway train, and they're concerned about being able to stop it, then the mortgage market declines. So to put this another way, the Fed funds rate increasing does not necessarily imply that mortgage bonds will become less valuable or that mortgage rates will increase. But if the Fed starts forecasting or otherwise making public statements that they're concerned about inflation and that it's likely that inflation will continue to be a problem, it'll be hard to beat, then mortgage bonds will lose value and mortgage rates will go up. So that is how the Fed can indirectly cause mortgage rates to go up. Now let's talk about the Fed and politics. I'm hoping to avoid a political slant in this description, but otherwise explain at least what the intention is for the Fed in light of our government. The Fed is not intended to be politically biased. It's designed to be an apolitical institution. What does that mean? The Fed is designed to protect the well-being of our country's economy without being pressured by short-term political goals. So we think of election cycles, midterms, presidential elections, depending on how well the economy is doing, depending on how well the Fed is saying that the economy is doing, could potentially impact voters and optimism for whoever's currently helping run our country. And so the Fed is designed to fly totally independent of politics and political parties. The governors of the Federal Reserve are nominated by the president. So yes, this is where some influence can come in. Now, the important part is that nominations are staggered every 2 years. What this means is it prevents any one president from stacking the deck, so to speak, by nominating a bunch of, Federal Reserve governors that are in alignment with that particular president's beliefs. So here is a helpful site from the St. Louis Fed. The St. Louis Fed offers this whole educational platform that I really appreciated looking through. The St. Louis Fed also offers a significant amount of data. So what you're able to do is look for data particular to your state, particular to the economy, and you're able to see a whole bunch of enlightening data such as Wisconsin housing starts, for example. So you can query all sorts of things relative to your particular state or where you're located, and you can see things like housing inventory, active listing count in Wisconsin. Back when I bought our first single-family home in 2017, we thought it was an aggressive market. Looking back at this chart, there was 27,000 active listings that did not have an offer on it. Now, we've bottomed out in Wisconsin as low as 5,000, as low as 4,000 active listings in all of Wisconsin that do not have an offer on it. And still we're at about 8,200. So this goes to show again and again that with our deficit of property available, there might not be an end in sight for several years. So what does this mean for homeowners? Data like this shows us that we have a major undersupply of housing, and you can look at your local economy to further reinstate that. Who cares what's going on in Wisconsin if you live in California? So the Fed aggregates data like this that can be very handy for realtors, for loan officers, and then for clients as well. When working with a realtor loan officer that understand how to make this applicable for you as the consumer. So here's the final question I get asked a lot. What exactly does the Fed do if they have 18,000 employees? Are they just another bloated federal department? Again, I'm attempting to avoid political bias. Here are a few other things that the Fed is responsible for. High level, we want the U.S. to be respected as far as foreign economics is concerned. We want investments from other countries in our country. We want people to, take out U.S. Treasury bills and to purchase mortgage-backed securities because they trust the U.S. economy. So that's a major goal that the Fed has, is to maintain respect in the global economy, in that people trust the U.S. and they're willing to buy, let's say, a 10-year Treasury bill, where technically they're not getting that money back for 10 years, but there's so much confidence in the U.S. economy that they're willing to make that investment. So here are 4 different things that the Fed is responsible for. Various consumer protection actions regarding lending and deposit transactions with banks and lenders. So they're making sure that state, nationwide, and local banks and credit unions are maintaining responsible practices so that people are, being well represented, they're not being deceived or ripped off. Next, ensuring our nationwide banking system is healthy and sound, both nationwide banks and local community banks and credit unions. In other words, that banks maintain certain amounts of reserves and liquidity so that they don't get in a situation where we have to bail them out. If there is a run on the bank, obviously with social media now, these things would explode and it would be very catastrophic for our economy. So it's crucial that banks maintain liquidity. If you want to withdraw $100,000 that you have on deposit, that money better be there and they better be able to provide it to you. Next, provides a responsible marketplace to earn the trust of other countries. So as I said, we want investment and trust in the US dollar, which is why there are trillions of dollars of investment currently held in US Treasury bills and mortgage bonds. Finally, the Fed helps manage the flow of money between banks and internationally as well. So at its best, the Fed helps keep our country on the rails, keeps our country as far as foreign policy is concerned on the rails, and maintains the respect of the global economy. Hope this video was helpful. If you like this type of content, make sure to subscribe, ring the bell, and if you have questions, please do leave comments. I can't wait to read them and respond.